Hello, very good morning to all, and welcome to a brand new week ahead. Kelvin Wong here again, the Senior Market Analyst of OANDA Asia Pacific. So, overall, let me do a check for a while. I believe that you guys could see my screen right now. All right, give me a minute now. Let me check again. All right, over here, I think there's a bit of lag due to the internet connection. My apologies at the start. So welcome to this week OANDA Asia Pacific Daily Dose of Market Insights. So today will be the brand new week. Welcome to Monday, a brand new start of the week. Today will be the 26th of February 2024. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses could exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the technical chart of the short-term technical outlook of the various broad-based cross asset classes, let's have a recap of what has taken shape on last Friday. So last Friday was a rather quiet session, no major movement, and as well as there's no key economic events and data that has taken shape as well on last Friday. So basically, I would say that the broad-based US major stock indices was almost kind of lackluster in terms of the intraday movement on last Friday. So the SPX is actually almost unchanged, positive 0.03%. The Nasdaq 100, a bit of profit taking, that's pretty much normal. Why? Because prior day on Wednesday and Thursday, we do see a very high volatile movement in terms of the Nasdaq 100, especially on Thursday, where they actually outperformed sharply due to the very stellar upward stellar movement of Nvidia due to its exposed earnings. So Nasdaq was actually the underperformer on last Friday, down negative 0.37%. The Dow Jones Industrial Average was the top performer, positive 0.16%, followed by the Russell 2000 up positive 0.14%. So overall, right, for the entire week, the SPX has a weekly gain of 1.66%. So that is actually the second best year-to-date return. Okay, the Nasdaq 100 is also up positive 1.42%, slightly below the SPX. The Dow Jones Industrial Average is up positive 1.30%, which is also the second best year-to-date return so far. And the Russell 2000 is up positive 0.79%. All right, so that's for pardon me. The Russell 2000 is underperformer. My apologies. The Russell 2000 is actually down negative 0.79% for last week. That is the weekly performance. Okay, it's one of the underperformer, but not too scary in terms of the overall we call it aggregate performance of the entire major US stock indices. So if you look at the daily, okay, let me share my screen again. So if you look at the heat map of the S&P 500 on last Friday, this was last Friday. So you see a bit of profit taking on the technology space, all right, over here, whilst the rest of the component within the other sectors, almost all of them have positive daily gains on last Friday. So it's pretty much normal to see prior on last Thursday and Wednesday, there's actually a very sharp intraday positive move among the technology space, especially Nvidia. So that's pretty much normal to see a bit of rotation back into the other rest of the sector. Okay, so now then what we have over here is what's interesting I want to share with you all is the US 10-year Treasury yield, which is also one of the important macro linkage in terms of risk on, risk off. So like I would explain previously over here is that if we start to see a pickup in the US 10-year Treasury yield, that means if the US 10-year yield keep going up higher and higher, is indicating to us that long-term liquidity condition getting tighter, which is pretty much undesirable for a continuation of that risk-on behavior in US stock indices as well as primarily the rest of the world. So what we could see over here is that in the last few sessions, the US 10-year Treasury yield has already hit the lower limit of this major resistance zone of 4.33% slash 4.5%. You can see over here, so that's also close to the 50% retracement of that previous medium-term down move from 28th of October to 28th of December last year. All right. So what we could see over here is that there's a bit of exhaustion at this point in time at this 4.33%. So who knows, over here is that potentially this could be a tipping point in terms of the potential medium-term bearish reversal of the US 10-year Treasury yield to allow it to inch much lower. And that potential downside trigger will be that 200-day moving average, which is also acting as a near-term support at 4.14%. So a breakdown below 4.14% potentially could kickstart another round of a multi-week down move in that US 10-year Treasury yield, which is net-net, it could potentially have a positive macro spillover effect to risk assets. That means, i.e., potentially positive for the major US stock indices, because given the fact that a further down move in the US 10-year Treasury yield implied liquidity condition is not tight. In fact, liquidity condition continue to be in a easing mode. All right, and if you look at the its daily RSI, all right, over here its daily RSI also starts to shape a similar high. Okay, some form of resistance has been formed as well. Okay, something to keep a eye watch on. And also, do not forget over here is that the US 10-year Treasury yield, if it's going to inch down much lower, it will also add downside pressure on dollar strength. Why? Because that means, i.e., the yield premium between US and the rest of the world starts to get lesser. That means in terms of the fixed income perspective, US fixed income is relatively less attractive versus the rest of the world. So that could also potentially put downside pressure on the US dollar as well. So if you look at the US dollar index, US dollar strength has been pretty much subdued after that rally, that strong rally that was seen in okay, let me share you. Yeah, this is the dollar index. All right, so after that very strong rally that was seen around 1 week ago or 1.5 weeks ago, due to the hotter than expected US CPI data, price action start to be pretty much subdued, but managed to survive at the near-term support level, which is the 200-day moving average, which is the 103.70 support level. So view that 103.70 support level, 103.70 support level on the dollar index in parallel with the US 10-year yield near-term support at 4.14%, which is also the 200-day moving average, I think, as a support. All right, so either one of them start to break down below this respective what you call it, downside trigger level, potentially we could see a significant movement taking shape in the global markets. So overall, right, what we could see over here is that it's managed to survive one time, two times, twice so far at the near-term support for the dollar index at 1.0379. So if we start to see a breakdown below 103.79 on the dollar index, so that should become in line with the breakdown of 4.14% on the US 10-year Treasury yield. So potentially we could see a bit of triggering of a potential more substantial dollar weakness coming back into the FX market. So if you look at on a weekly basis on the dollar index chart, so on a weekly basis on dollar index chart, what we could see is we start to see a bearish reversal candlestick, which is a shooting star, okay, a bearish shooting star, and on the prior week of 12th of February. So where this shooting star formed, for those who have followed our daily dose of market insight, it formed at the key medium-term resistance level at 104.85. So what's 104.85? Graphical resistance over here, you know, on the daily chart. So if you switch back to the daily, we do see this level here, this bunch of congestion area. And if you go back to the weekly chart again, it's actually the previous down move of the golden ratio of 61.8% Fibo retracement of the previous medium down move from 2nd of October to 26th of December. And very interestingly, on last week, so this is a weekly chart. So on last week, it closed down negative 0.3%, but it do have kind of have a bearish candle, weekly candlestick follow through after the emergence of its prior week bearish weekly reversal shooting star candlestick. So there's what I call more and more clear weak technical elements that actually potentially capping dollar strength going forward. All right, so this is something to take a light watch off. Also, with dollar strength being kept over here, it could actually potentially spill over to the gold market as well, because you know that dollar strength increasing, gold will tends to get weaker, indirectly related to the 10-year US Treasury yield, because for those who knows that gold itself is a zero yielding asset class. All right, that means if you hold gold, it doesn't give you interest rate income. All right, so for that, with dollar strength being kept technically, as I shown you on the chart as well, and the weakness of the US 10-year Treasury yield, gold managed to actually inch much higher on last Friday, positive 0.54% for gold. That means spot gold, that's XAU/USD. So it very interestingly, it hit that range resistance that we've been keep on highlighting for the entire last week, which is 2042, and it ended the week at 1.1% weekly gain. All right, and this 1.1% weekly gain for gold is the best weekly gain so far since year to date. All right, since the start of 2024. So later I'll touch on more detail on the short-term technical outlook for gold. All right, then for WTI crude oil, we in the expectation it's going to inch lower, come break off above the medium term range resistance of 78.40, 79 figure US figure level. So that is a 78.40, 79 figure level that's on the WTI crude. That is the range resistance. So it ended last Friday with negative 2.24% losses, and for the week it also added a weekly loss of 2.1%. Okay, so without further ado, that is the key highlight that took shape on last Friday, and as well as the clear important macro linkage that I like to share with you earlier on. Okay, now let us now jump straight to the short-term technical outlook for today. I mean, on a very short-term basis, what we are going to actually what I'm seeing right now in terms of the charts, all right, of the various cross asset classes. So let us start with the major US stock indices, major stock indices first. Pardon me. All right. Okay. So with that, right, let me expand my screen so that you guys could see clearer. Okay. So let us start with the Asia market. So Hong Kong 33. So for Hong Kong 33 right now, which is the Hang Seng Index, a bit of profit taking so far at the start of the week, down negative 0.3%. So far, it managed to hit the first resistance that we highlighted on last Friday, 16,000, pardon me, give me a minute, let me remove this. Okay, 16,760/16,860. So right now, potentially there could be a bit of pullback taking shape, given the fact that the RSI has now managed to actually inch down below the 50 level mark and hasn't come close to the oversold level yet. So potentially there could be a bit of pullback over here. So with that, I will have a kind of a more tightened key short-term pivotal support level for now, using the median of this minor ascending channel that is in place since 22nd of Jan, and also the former minor range resistance of 16th of February and 20th of February, and as well as the the minor impulsive up move from 20th of February all the way up to last Friday's swing high. So that's give us the golden ratio of 61.8%. All right. So given that we have three different kind of technical elements pointing close to a similar support level, which is 16,350. So that will be my key short-term pivotal support for today to maintain this ongoing bullish bias as price action continue to evolve within a medium term within a kind of a short-term counter trend rebound scenario. As long as 16,350 short-term pivotal support holds for now, potentially we could see the extension of this ongoing potential short-term counter trend rebound scenario. Above 16,860 exposes the next intermediate resistance to watch will be at 17,010, 17,130. Graphically is the swing high area of 2nd of Jan and the Fibo extension cluster level, and as well as the upper limit of this minor ascending channel from 22nd of Jan okay, that I draw from the low from the 2nd Jan over here, all confluencing at 17,010, 17,130. Only an hourly close below 16,350 will potentially see the extension of this minor corrective decline within this minor ascending channel to test the lower limit of the minor ascending channel, acting as a support at 16,140 slash 15,950, which is so confluence with the 20-day moving average as well. All right, so net still maintain that short-term bullish bias on the Hong Kong 33 index with a much more tighter key short-term pivotal support for today at 16,350. Now, the Japan 225, which is i.e. the Nikkei 225. So in Japan 225, previously on last Friday, we do highlight the first resistance to watch at 39,510, 39,600 level over here. Right, so price actually indeed hit that level, and we do cautious of a potential minor pullback at that point in time. Why? Because the RSI is at relatively extreme overbought level on the hourly basis. So what I could see right now is that the RSI really starts to come down and work off its extreme overbought level, and now approaching very close to the oversold region as well. So yes, this minor pullback over here could be still ongoing. I don't want to tighten it so tight right now using this today's intraday session low as my short-term pivotal support. So I'll maintain it at 38,850, which is the former minor swing high of 16th of February. We saw very close to the previous all-time high level that was hit 34 years ago in December 1989 at 38,950. So as long as 38,850 short-term pivotal support going to hold in any potential pullback on the Japan 225, we will still maintain that short-term bullish bias on this index, with the next resistance to watch will be at 40,090, the intersection of this two different we call it time horizon upper limit of the ascending channel. Firstly, in gray, the minor ascending channel that I drew from the low of 7th of February, and in light green, that will be the medium-term ascending channel from the low of 4th of January. All right, so net overall, we'll still maintain that short-term bullish bias as long as 38,850 short-term pivotal support holds in any potential minor pullback. But however, if we start to see a breakdown below 38,850, that means the hourly close below it will negate this bullish tone to see the extension of this minor corrective decline within its medium-term uptrend to expose the next near-term support level at 38,450, 38,100, which is the swing low area of 21st of Feb and 21st of Feb level. All right, this level here, 21st of Feb. All right, now the European index will be German 30, which is the DAX. On German 30, price action going to trade sideways below the first resistance that we highlighted on last Friday, which is at 17,470. So if you look at it over here, is that price action on the RSI now is breaking down below the 50 level mark, hasn't really come close to the oversold level yet. So potentially, right, we could see a kind of a minor corrective decline taking shape within this short-term uptrend phase that is intact since the low of 14th of February 2023, as being depicted by price action evolving within this minor ascending channel that I drew from the low of 4th of December after that bullish breakout from a medium-term expanding triangle range configuration that previously taken shape on the 30th of Jan, okay, which is this year. No, 30th of January this year, pardon me. Yeah. So as long as any potential pullback level to watch, so the first pullback support level to watch will be at this 17,290. So I don't want to put it so tight at 17,290. I'll still use the close to the lower limit of the minor ascending channel from 14th of Feb, also confluencing with the former minor swing high area at 16th of Feb, all pointing to the same level at 17,180. So as long as 17,180 short-term pivotal support holds in any potential pullback, we will still maintain that bullish bias on the German 30. A breakout above 17,470 will seize the next intermediate resistance coming in at 17,590 slash 17,630 Fibo extension cluster, and also confluencing with close to the upper limit of this minor ascending channel. Only an hourly close below 17,180 will see the potential extension of that minor corrective decline to expose the next near-term support level at 17,000 figure level, psychological level, and as well as the minor swing low area of 20th of February. US indices. Let us start with the Dow Jones Industrial Average, which is the US Wall Street 30. We name it in our platform. So first support resistance level has really been made on last Friday with that short push up at 39,150. So net overall, if you look at the RSI, yes, RSI is overbought. Right now, what we could see is that after hitting that session, that level, a burst above 39,150, then price action start to work off from its extreme overbought level. But the way it work off that extreme overbought level, the RSI does not come with a bearish divergence. That means, i.e., RSI move in line with the price action, showing higher high. So what we could see over here is that the working off of its prior extreme overbought condition is more or less indicative of a minor corrective decline scenario in terms of price action, rather than a minor bearish reversal condition on the US Wall Street 30 price action. So what we could see over here is that I will have a tighter key short-term pivotal support for today to maintain that bullish bias, the short-term bullish bias in US Wall Street 30, using 38,770 as my short-term pivotal support level, which is the former minor swing high area of 16th of Feb. 16th of Feb, and as well as 22nd of Feb, broken up turns into a pullback support. And if you look at the last minor impulsive up move from 22nd of Feb all the way up to last Friday intraday high, that's actually the 50% Fibo retracement as well. And also with the 20-day moving average that is coming close to act as this support in a daytime, I believe so, okay, because it's upward sloping. So as long as 38,770 tighten key short-term pivotal support holds on the US Wall Street 30, the next, in any potential pullback, the next resistance level to watch will be at 39,400, followed by 39,610, which is close to the upper limit of this minor ascending channel that I drew from the low of 18th of January, and as well as not minor, medium term, I would say, as well as the Fibo extension level that I draw right now for you guys to see is the 1.618 Fibo extension level as well. However, if we start to see a bearish breakdown, that means an hourly close below 38,770 will negate this bullish tone to see the extension of that minor corrective decline in play to retest the swing low area of 22nd of February, which is at 28,430 slash 38,000 to get 38,430 slash 38,360. We also confluence with the lower limit of this medium term ascending channel that I drew from the low of 18th of Jan 2024. Now, what's up for the Nasdaq 100? So on the Nasdaq 100 over here, price action continued to pull back within our expectation after a retest of the 18,000 slash 18,030 level. So I don't want to use the first near-term support level to watch, will be at 17,810 as my short-term pivotal support. So still using 17,650 as my short-term pivotal support level, which is pretty much close to the upward sloping 20-day moving average as well. So any potential pullback managed to hold above 17,650, we will still maintain that short-term bullish outlook on the Nasdaq 100, with the next resistance to watch will be at 18,220 slash 18,270. All right, only an hourly close below 17,650, that means a bearish breakdown below 17,650 will negate this bullish tone to potentially expose the 22nd of February minor swing low area, I think as a next support level at 17,350 level. All right, so now we cover much ground on the major stock indices. So all of them, we still maintain that short-term bullish bias holding above their respective parallel short-term pivotal support. Okay, now let us go to the FX market. So let us start with the euro dollar. So on the euro dollar, pretty much sideways. So price action going to trade sideways around the this 200-day moving average, but still managed to hold right at the lower limit of this minor ascending channel that I drew from 14th of February, and as well holding above the 20-day moving average as well, still acting as a key pivotal support level that we highlighted on last Friday at 1.0795. So as long as 1.0795 short-term pivotal support holds, we will still maintain that short-term bullish bias on the euro dollar, with the first resistance to watch out for today will be at 1.084. So 1.084 is in fact last Friday swing high area, last Friday minor intraday high area. All right, so first resistance will be at 1.084 level. Break up above 1.084 level, may see the next intermediate resistance coming in at this 1.0890. So 1.0890 seems to be a bit of a range resistance that is in place since 26th of January. All right, and also conversing the 50-day moving average as well. However, an hourly close below 1.0795 will invalidate this bullish bias on the euro dollar to see a kind of very complex minor corrective decline scenario to take shape again, all in all to expose the next near-term support level or next intermediate support level to watch will be at 1.0735/1.0725. Sterling dollar, which is the pound versus the dollar. So the pound also going to trade sideways, pretty much sideways over here, but managed to hold above the 20-day moving average as well, I think as a support at 1.2640 or 1.2635. So I don't want to use so tight at 1.2635. I'd rather use the minor swing low area that's being tested 1 time, 2 times, 3 times since 21st of February last week. Okay, and also corresponding to this minor ascending trend line that I drew from the low of 14th of February in light green. So as long as 1.2610 short-term pivotal support holds for the sterling dollar, we will still maintain that short-term bullish outlook on the sterling dollar. Right now, with the first resistance to watch will be on last Friday's swing high area, or last Friday intraday high area at the 1.27 figure level. Okay, so above 1.27 figure level, may need to see the next intermediate resistance to come in at 1.2640 slash 1.26 not 1.26 1.2740, pardon me, slash 1.2760. We also confluence with the minor descending trend line that I drew from the low of medium-term descending trend line that I drew from the high of 28th of December. However, if you start to see a breakdown below 1.2610, that means the hourly close below 1.2610 will invalidate this short-term bullish bias on the sterling dollar to kickstart another round of pretty much complex corrective decline scenario to retest the support level at 1.2540 slash 1.25 figure level on the sterling dollar. Asia Pacific currency, the dollar yen. So dollar yen, no change. For sure, this is a clear sideways range movement in place since the mid of February this year. So as long as 150.70 short-term pivotal resistance holds for now, potentially we will still maintain that short-term bearish bias within a range scenario to see the range near-term support level to watch will be at 149.60 level. Only a breakdown below 149.60 level will expose the next support zone at 148.80 slash 148.40. However, you start to see an hourly close back up above 150.70, will potentially see a squeeze up to retest the major resistance zone of 154.40 slash 151.95 on the dollar yen. Aussie dollar, so Aussie dollar going to be trading sideways as well, holding above the 20-day moving average, which we have as a short-term pivotal support level on last Friday, 65.40. So as long as 65.40 short-term pivotal support level holds, we'll still maintain that short-term bullish outlook on the Aussie dollar. But however, we do have a near-term resistance to take note of will be at 65.80. So that actually corresponds to last Friday intraday high. So only a clearance above 65.80 potentially will see much more impulses for the bulls for the next intermediate resistance to come in at 66.20, which is the range resistance in place since 24th of January, also confluencing with the 50-day moving average as well. However, if it starts an hourly close below 65.40, that means a bearish breakdown below 65.40 will invalidate this bullish bias to kickstart another round of minor corrective decline to retest the psychological level of 65 figure level slash 64.70. So if we do the Fibo retracement of the current push up from 14th of February low, is actually the 61.8 Fibo extension and the 17 Fibo retracement and the 76.4% Fibo retracement as well. Okay, so now that pretty much sum up for the FX market. So what you could see on the FX market over here is dollar strength seems to be on the various respective resistance. All right, spot gold XAU/USD. So XAU/USD, it the price actually almost hit the 2042 level symmetrical triangle range resistance that is in place since the high of 28th of December. So overall, what we could see right now, the RSI doesn't shape any bearish divergence yet. Okay, there's no bearish divergence on the RSI. So what we could see over here is that potentially the RSI now is trying to turn up above the 50 level. Okay, so with that, right, we will still have that short-term bearish bias on spot gold XAU/USD, but there are three levels to watch over here. First, for sure, will be the short-term pivotal support. So we have adjusted short-term pivotal support at 2022. So what is 2022 is slightly below the 20-day moving average, but in line with this minor ascending trend line support level, minor ascending trend line that I drew from the low of 14th of February, also confluencing at this 2022 level. So as long as this 2022, we call it adjusted short-term pivotal support holds on spot gold XAU/USD, a clearance above 2040, as long as 2022 short-term pivotal support holds and a clearance above 2042 level, which is that symmetrical triangle range resistance, may see the next intermediate resistance to come in at 2059/2064, which is correspond to the minor that range resistance, that this range resistance in place since 5th of January, okay, which is the swing high area of 5th of Jan, 12th of Jan, and as well as 2nd of February, okay, confluencing at this resistance zone at 2059/2064. However, only an hourly close below 2022 will invalidate this short-term bullish bias on gold to see another round of choppy corrective decline movement to retest 2011, followed by 1965 level on spot gold. Right, then WTI crude oil. So WTI crude oil continued to actually pierce down much lower over here. So now breaking below the first support level that we have at 76.60 on last Friday. So I do not put it so tight in terms of the short-term pivotal support level. So the potential, because right now it's already at the oversold level. So being at the oversold level, but what we could see over here is that price action do not shape a bullish divergence, going to show lower high, lower low, okay, over here. So yeah, oversold but no bullish divergence. So there could be no what I call a clear signs of a bottoming in terms of minor bottoming in terms of the RSI, okay, in terms of the RSI for West Texas oil. Okay, this is our reach of West Texas oil. So potentially there could be a snapback, okay, a snapback. So where would the snapback potentially snapback level? So any snapback level could be at the 77.60 level, which is also close to the 200-day moving average, as well as the former minor swing low of 22nd of February, now acting as a pullback resistance at 77.60 level. But so I will still use this level here, 78.40, 79 figure level as my short-term pivotal resistance level, rather put it so tight at 77.60 marker level. So as long as 78.40/79 figure level holds in terms of the short-term pivotal resistance, which is the range, my medium-term range resistance as well of the symmetrical triangle range in place since 14th of November. So price action of West Texas oil will still maintain that short-term bearish bias, with the next support level to watch will be at 75.75. A breakdown below 77.75 exposes the 50-day moving average, acting as a support at 74.40. Right, so still maintain that short-term bearish outlook on West Texas oil as long as 78.40/79 pivotal resistance holds. But however, if we start to see a breakout above 79 short-term pivotal resistance level, that means clear hourly close above this level, will invalidate this view to start to see a much more pronounced push up towards 79.80, followed by the next resistance at 86.65 over here, which is the congestion area here as well. All right, so with that, that pretty much sum up for the short-term technical outlook. So before we come to the 30-minute mark already, let's take a look at the calendar on this week over here. For this week, for today, pardon me, not this week. What are the things to look out for today? Okay, so let us start for this week over here. Okay, let's expand my screen. Okay, so for today, it's a rather quiet day in terms of the economic calendar for the Eurozone. So the only clear key economic data to look out for will be from US at 11 p.m. Singapore time today, which is the new home sales data for January. And tomorrow, something to look out for, early Asia session at 7:30 a.m. will be the inflation rate for Japan. So the core inflation rate for Japan, as well as the inflation rate ex food, core rate, ex food and ex energy. So it's at 3.7%. So market is actually there's a market is expecting slightly lower at 3.2% year on year. Right, so something to take a look out for that could actually impact the Nikkei 225 and as well as the dollar yen movement that going to be released in 7:30 a.m. tomorrow, before the start of our daily dose at 11 a.m. Okay, so with that, that pretty much sum up for today daily dose of market insights. So do have a great day ahead, and we shall speak again tomorrow. Thank you.